Year ended when? March 20, which one? 2014. So have that. So in the profit account, we start with the revenue. The revenues which we determine from those revenue accounts, you start with them here. So you write revenue. Marine, the revenue account for marine and fire. How much was the revenue from marine? 1040. How about this other one? 1815. Therefore, total is 2895. These are the revenues we got from the revenue account. Is there investment income, dividend income? Can you check? 50 or 55? Sure. 55. Any other income? Check the trial balance. Is there investment income? Quite common. Yes. If yes, how much? So another income, we have investment income. You'll say how much? 80. Bring it there. Then you less expenses. The expenses which you're supposed to subtract are those expenses which were not specific. They were not related to marine and fire specific, so they are considered to be general. So let's bring them here. So which ones can you capture? I remember there was audit fees, director's fees, they were not specific, sure. So bring them here. Audit fees. Audit fees was how much? 240. So this was 240. Director's fees. You are saying? 495. 495. There was depreciation. So depreciation. You are saying was 05. I don't think if there is any expense apart from those ones. Management and bad debts were specific to marine and fire, and we took them into account. So there is no any other expense. Can you add the three? You get? 1640. And because there was tax, what you get here, you call it profit before. Profit before tax. So how much is that profit before taxation? Yeah. What did you find? 1495. Tax was mentioned in a certain note, note 7, 6, 7, 8. They said we charge tax at what rate? 30%. So less income tax, 30% of the profit. You charge 30% of the profit. That one comes to how much? Huh? 448.5. You less. Therefore, PAT, profit for the year after taxation, will be how much? Yeah? 1040? 6.5. So we are done with P&L. We are done with P&L. I want us to go to the statement of financial position. Good, that is done. So let us go to the statement of financial position. Let's go to the balance sheet, then we wind up. In the balance sheet, I realized there was a typing mistake. Check, it was investment in shares. How much has been indicated there as investment in shares? 1,400. It was to be 15. In fact, if you add that to a balance, you'll realize the debit is less with 100 because there was a mistake. So just change that. Investment in shares is 1,500, not 14. It is 15, not 14. So let's prepare the balance sheets. So non-current assets. Which one? Investment in what? Investment in shares, let Apple 1,500. So we have so investment in shares. Investment in shares. That is 1,500. After investment in shares. Okay, but on that, what do we have? I don't have that in the set here. I like Apple fuel. then another one, then another one. So freehold property. Freehold property, how much? 200. So the value. Next. Motor vehicles. So motor vehicles, how much? 500. Followed by machinery and equipment. How much? 1,500. Followed by furniture. How much? 1,300. That depreciation in the balance is not really clear. We only subtract capital up and down. Nothing else. Can you add? Add the total and current assets. Good. 12,000. Give us here. Current assets. Was there cash or bank? Check to confirm. Cash stock bank or bank check. Or debtors or receivables. Sundry debtors. How much? Sundry debtors. 730. Followed by cash and bank. How much? 10. Then there are some which are not very direct. Unaona ile walisema outstanding premiums. Outstanding premiums are premiums which we are yet to receive. So they are premiums receivable. So bring them here. Outstanding premiums. Outstanding premiums. Can you add the two? You should pick the closing because balance sheet is prepared at the end of the year. So pick the closing premiums, the closing. Because I think note 1, additional information number 1, or you can check from your presentation, whichever. What plus what? What plus what? 15 plus 700, giving you 32. 32. Then there is commission ceded. Commission ceded and receivable. Commissions ceded. There were 2. Can you check? What plus what? We calculated that one. If you don't get direct with the question, we calculated the 5% of those ones. You got 40 plus 25, giving you 65. Only that. I don't see anything else. So can you add? How much is that? That's 105. Giving you total assets of how much? 15,105. Then we go to equity. Go to equity. So right there, equity and liabilities. equity and liabilities, as we find, like that. Equity and liabilities. Equity and liabilities. So ordinary share capital, share premium, retained earnings, and any other reserve. So was there ordinary share capital? Okay, give us there 3,000. Ordinary share capital, I'm told is 3. Share premium. Share premium, I'm told it is 1,000. Followed by profit and loss account. That is retained earnings. So retained earnings 450. So you take 450 plus the profit you have determined here for the year. Where's our profit for the year? After tax, 1046.5. Whatever we have determined in the P&L. So we have determined 1046.5 minus. Check a certain note there. There was the concept or element of proposed dividends. I don't know which note. Note 5. 10.5. So when you propose dividends, when there is anticipation of paying, of course, in accounting, we have to expense. So reduce the retained earnings with the profit, with the dividend which has been proposed. Whether paid or proposed, you have to reduce. So it is 10% of the share capital. So 10% of this one. So this plus this minus the 300. How much? How much is that? 1196.5. Then there was reserves. Any reserve is equity until it is utilized. So check for me. There was reserve for unexpired what? Unexpired risks. Of course, at the end of the year, that provision we made. Can you check? I remember it was 58 and 19. Check to confirm. The provision for the unexpired risks. It was being maintained at 100% and 50% of the net premium. So check in your books, in the solution. Cut it down. We set aside 58. Sure. Was it 58? 56, eh? This one is 19. And 19, okay. So that one will be 575. So you add. So total equity comes to how much? 1296 point. 12,696.5. Current liabilities. Can you check payables or sundry creditors? There was sundry creditors. Okay. How much is the sundry creditors? 330. 330. Then there was current tax. Tax they just said was to be provided. It was how much? Tax 30%, 448.5. Proposed dividends. When you have proposed dividends, you have to pay. You have just made a provision. This one here, 300. Commissions accepted are payable. How much and how much? What plus what? What plus what? 60 plus 40. That is 100. There were some claims which were outstanding. The ones they were calling intimated and outstanding. I don't know, note 3, 4, 5 there. Note 4. So outstanding claims. Outstanding claims, they haven't paid. What plus what? How much plus how much? 750 plus 40, giving you 1230. Right. I don't think if there is anything else. Can you add? Add that one. $24.08. $24.08.5. If you add total equity and liabilities, it is in agreement with our total assets. Because our total assets was 15,105. So I want to check that other question, that question too. I'm still trying to check if I can get any other question as per this new standard. In case I come across before the D-Day, we can revise as part of revision, but for now, we don't have. You can try that other question at your free time. For the purposes of time, see my insurance, provided you know the format of revenue accounts, you are good to go. So practice with that. For now, you allow me to start a new topic. So we are the ladies to check for me IAS number 19. Gents to Google for me. Ifrs 39. Yes. IAS 19. For ladies, you have to tell me what it says. Then gents, we can check Ifrs number 39. What are they talking about? I think that should form part of our next. Those who are new to the class, here we are in technological what? People are allowed to Google, there's no problem. Provided you will not Google during the exam. So IAS 19 is talking about what? Employee benefits. How about government? Ifrs number 39. Ifrs number 39. Yes, Kaukurai unasema.
It clarifies the presentation of service costs. Yes.
Iko na kizungu mingi hivyo. Unasikia mwenye huyu amehit mbio employee benefits full stop. Kuna kizungu it clarifies. Ifrs 39. Yes, yes. 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 So employee benefits, it clarifies. So for public sector, they talk of it as 39. which just replaced IPSAS 25 for the employee benefits. For commercial, private commercial entities, they apply IS number 19. So that is our next topic. So right there, IS 19 stroke IPSAS, IS 19 stroke IPSAS 39. Stroke IPSAS 39. So in the questions, before 2018, utapata IPSAS 25. So in brackets, naandika previous IPSAS 25. I said IS 19 stroke IPSAS 39. In bracket, previous IPSAS 25. Employee benefits. Employee benefits. Employee benefits, yes. So it's never good to judge, but from the looks of your faces, those people are physical. I don't think if we have someone who is a Muslim here, physical, I don't know what's going to be to judge. But from online, Farida, from your name, I can maybe tell, and some others. So, Quran and Bible, they are similar in the Old Testament. Are you aware? Yes. They are all similar in the Old Testament. There is no difference. So in the Old Testament of the Bible, in the books of Ecclesiastes, today we are in church. In the books of Ecclesiastes, there is somewhere they have written that there is time for, yes. Pastors have talked Ecclesiastes. So, you can tell us in the Quran where it is found. So in the books of Ecclesiastes, there is time for everything. Time to join an organization and time to do what? To live. And when you live, at least you should be given some what? Benefits. So ours is going to be, how do you calculate these benefits and how do you report them in the financial statements? Nothing much. So that topic, I have to give you a caution, is frequently examined, very frequent. It has a sister topic called share-based. The two can't miss in exam. So the virtue I realized, they examined employee benefits last sitting. That is not a sure bet that now it might not come wrong. What I know, employee benefits missing with share-based is difficult, but there are some instances where they set all of them in the same sitting. So you have to take it seriously. From now onwards, I'll be saying which ones. So take it seriously. So I have like 3 pages notes. The state I am in right now, I'm not feeling well, I can't dictate. And as the norms, so I want to share those notes, the best you can do. We discuss them. We cannot even exhaust. So go to the group. I send you the notes on IS number 19. Write them down. We discuss, then we can be able to do the questions comfortably. So give me a minute to check for you the notes. So those who are new, that is what we normally do actually. Instead of me dictating, then people are telling me repeat. Repeat. We just share so that we are good. So it's like 5 evening. I've shared. So I don't know how many minutes you can take, but the way I know you people, this one can take you like 6-7 minutes. Umefungua? Oh. Weka Wi-Fi. Those who are new, we have Wi-Fi here. And this Wi-Fi, we say it is very unique. It can even work when you're at home. So have them written. Those who are online, you can even switch from online. Once you are done, you come back. Bora will go for speed. I want you to write, we discuss then. We have so many questions on employee benefits, we can't exhaust all of them. Thank you. Leo lazima tufollow. So alafu niende ninunue ingine kama hii, si ndio? So that thank you. Mtu anameza na maji ama natafuna? Kama sote. That is even better. Speed. Nika mbio. Unasikia mtu anasema I'm done. Na wewe bado uko paragraph 2. I hope the handwriting is visible.
No.
Online confirm that you are done. Let's go through what you have written so that we can move forward. The objective of IS 19 is to prescribe the accounting and the disclosure for employee benefits, requiring an entity to recognize the liability where an employee has provided services and to recognize an expense where the entity consumes the economic benefits from employees' services. Examples of employee benefits includes 1, salaries and wages, post-employment, medical and life insurance benefits, and we have jubilee benefits. Jubilee benefits are which benefits? We got this. Ukifika 50 years. Okay. Then we have termination benefits, profit sharing, and bonuses. The above benefits may be categorized into 2. We have short-term employee benefits, are those benefits which are expected to be settled before 12 months after the end of the annual reporting period during which employee services were rendered, excluding termination benefits. So short-term benefits are benefits which are paid within a period of 1 year within which the services were provided. Then we have post-employment benefits. These are benefits attributable to an employee upon retirement. The entity may have formal or informal post-employment plans for its employees. Fine. Types of post-employment benefits, there are 2. We have a defined contribution plan. Defined contribution plan and defined benefit plan. So a defined contribution plan is a benefit plan in which the entity pays a fixed contribution. However, the amount receivable in form of benefits is not fixed. Instead, it will depend on the performance of the fund investment, e.g. NSSF. But the NSSF will impact that value because now it's our account. How do you normally pay NSSF? Huh? How much? What was scared? Hey, how do you people, because how do you want whatever payroll? How do you normally work on NSSF? Mnakata gapi? 200.
Yes.
Hey, bado mko huko? Si hapo watu walitoka? Ndio naenda wapi? To be honest, me I think from 2018, yeah, you order the clip at 200. Yes. Mugenya anasema 6% employee, 6% employer. Actually, what she's saying is the correct thing. What happened, I'm not sure, but I think in 2015 or thereabout, there was actually when we go up at the law court, they wanted the employer to contribute 6% of your gross, and also you also contribute 6% of your gross. That is where the tier 1, so not tier 1, tier 2. That is where the tier 1 and tier 2 come, of which anybody earning 18,000 and above should contribute how much? 1080. It is 1080. Yes, 1080, 1080. Yeah, it should be 1080, 1080. Yes. So when that regulation was there, many people feared, and they started contributing as per. They thought that when that case, in case the case becomes successful, it might be backdated. Though the law does not apply retrospectively. So those who are contributing 200, fine, but most organizations, 70% are not using the 200. I know. Yes, most are not using 200. Kwenye mnatumia 200, be honest. Mnatumia 200. Your gross. Yes, so wewe unalipiwa kidogo. Utaretire ukienda claim at you have retired, utapata uko na 24,000. So tell them to be deducting a lot. In fact, they should deduct mpaka utoe uweke voluntary. So you should even have voluntary contribution, because furthermore, you know, it reduces the pay. So NSSF reduces pay. So it is one way of tax planning to avoid making more pay. So tell them to deduct more, mpaka uongeze voluntary to reduce the pay. So in a defined contribution, what is contributable is known. But when it's about I've worked for 20 years, times you 200 per month, so 400, you multiply by 12. Then at retirement, now you go to an SSF, but I also have my records. This is what, it cannot be the same. You will not get the same amount. In fact, the possibilities that you will get lower than what you have contributed. So yeah, Ama? What I'm saying, in a defined contribution, the amount you are contributing is what is fixed. You know what you are contributing, but what you will get always depends on the fund investment. Yeah. So it can either be higher, lower, depending, but it can't be exactly what you contributed. So that's a defined contribution. Then defined benefit plan. Yes, please. At the post.
There is a situation where there is a secondment, maybe a staff from one ministry to another for
Yes. Yes. Yes.
Maybe for a period of 3 years. then you go and work there. At the end of that period, you are paid graduate.
Yes.
Then you can assist us.
But okay, fine. Though this one goes to tax, but I can say kidogo. You know, gratuity you are only paid if the employer was not, you are not entitled to an SSF.
But what they use at 1% rate of what you are having to get the credit.
Yes, they use that, but you see, number one, gratuity you are not supposed to get when you are entitled to pension, the NSSF. So that is why they sometimes, at their own discretion, they take the 31%, or I don't know how they calculate it. Lakini sio mwende kufanya huko kwa tax. You inafanya huko kwa tax. Me hapa kwangu.
What I just needed was to know the category where credit will fall. Is it your term? Because now this
Definitely it will be short term. Yes, it will be short term.
So meaning we are not supposed to restrict ourselves to annual spend.
No. We are not restricted. Even mnaitaka surveillance, mnaitaka your service, mnaitaka surveillance. Yes, it will still fall under the short term. And then defined benefit plan is a form of post-employment benefit plan other than a defined contribution plan. Amount contributable may not be fixed. However, the amount receivable is fixed in advance. For example, now leave NSSF alone. Some of us work with insurance companies. They approach you, they tell you, if you contribute this amount, by the end of year 10, we'll be able to give you 10 million out of this. So you are not restricted that every month you must contribute the 6%, the way you say. But provided by the end of that year you have contributed what you agreed, and you'll be entitled to receive what you had agreed in the fund. So where the amount contributed is not fixed, but what you will receive is what is determined in advance, then that is a defined benefit plan. So what the examiner normally question there is just the differences between the two. Note, when accounting for defined benefit plans, various actuarial assumptions must be taken into consideration. So the people who normally predetermine how much you're supposed to get in the scheme, as we said in the previous class, are known as actuaries. So when the actuaries are doing that estimation of what you're supposed to receive, there are two factors which they consider. One, we have what is called final assumption. This consists of the interest to be charged on pension liabilities, future expected salaries and benefits levels, future medical costs, expected rate of return on plan assets. Then number two, we have what is called demographic assumptions. This deals with matters such as mortality rates during and after employment, rates of employees turnover, disability, and all that. The examiner can just ask you the two factors taken into consideration when making actuarial assumption. Actuarial assumption is when the actuary is trying to project how much you need to contribute. And even you have seen this, when were you born, what all those stories, the background, so that they can know in which category you're supposed to and how much you're supposed to contribute. So they take what is called final assumptions and the demographic assumption. We have something called multi-employer plans. This is where different entities contribute to different pension plans for the benefit of the employees. So work on a different pension schemes for the benefit of employees, such is called multi-employer. So accounting for defined benefit plans, how do you account for them in the books? IS 19 requires that an entity should recognize, this one you can be asked anytime. Najua kuna maswali hapo we check. IS 19 requires that an entity should recognize both plan asset and plan liabilities in relation to a defined benefit plan. When we talk of plan obligation, plan is the scheme is the fund. Contribute. So when you talk of plan obligation, the way we said last time, even when you save with a bank, so kuna bank charges, those are your obligations. Even the scheme has obligations. So you need to check how much is due, which I'm supposed to settle, then recognize that one as a liability. How much have I invested? So the amount you have contributed to date, that is what? Plan asset. So the standard requires that at the end of each reporting period, if an entity has a scheme, then you check how much has been contributed, how much is the liability, then you recognize them in the financial statement. In case the plan assets exceeds the plan liabilities, then an entity should recognize a surplus and a plan asset in the statement of financial position. Similarly, an entity should recognize the following components. So there is what is called service cost component, interest cost component, and we have what is called remeasurement component. Let check for May 2021. Question 5, May 2021. I think there's something about component they were talking about. May 2021, question number 5. Check something there. Just 5C, not sure. Let me check. Kindly read.
The objective of international public sector accounting standard, Ifrs 39 on employee benefits, is to prescribe the accounting treatment and disclosure for employee benefits in public sector entities. Required with regards to Ifrs 39, employee benefits describe the elements of measurement. This is the element of the measurement component of the net defined liability of the net defined benefit liability in bracket assets, and how the treatment of the measurement component are under Ifrs 39 compares with that of commercial sector entities under IS 39. IS 19.
Oh, so they were asking of the components of the measurement. Oh, fine. So when rule 1, when accounting for pensions, 1, you need to check between these two, between the plan assets. Plan assets is the investment which has been made in the scheme, and plan obligations. Which one is more? So if the plan assets exceeds the obligations, then you recognize what? A surplus. And the opposite applies. When this one is more than this, you recognize a deficit in the scheme. Then after that, if the plan asset is more than this, you recognize surplus. Then in the balance sheet, you recognize what? Assets. If this one is more than this, you recognize a deficit. Then in the balance sheet, you recognize what? Liability. That is 1. Then 2, you need to recognize some components. There's some components which you need to recognize apart from the asset and the surplus. So the components which you need to recognize are 3. There is what we call the service cost component, the interest cost component, and the remeasurement component. So in relation to that question, they want remeasurement. So let's check until we get the remeasurement. So service cost component, this includes the current service cost and past service cost together with any gain or loss on settlement or curtailment. Current service cost is the increase in the present value of the defined benefit liability resulting from employee services in the current period. To make what's easier, current service cost is the cost which the organization will incur in relation to the services which were rendered by the employees in the current year to maintain the scheme. Past service cost, on the other hand, is the change in the present value of a defined benefit obligation for employee services in the prior periods. So the last time I told you when we were doing that question for banking, you find that someone joined the organization in 2010, then there's someone who has just joined in 2022. When you people have struggled, then now is when the company wants to start contributing for, or is when they are joining retirement benefit scheme. So a good employer will say, those people who are there in 2010, let's backdate. So we backdate, then those who joined now, yours starts from now as we move forward. So the cost the entity will incur on the as a result of backdating, this one here, those ones are called past service what? Service cost. But you charge them in the current what? Yeah, you don't amend the financial statement. You just charge right now will be the future. Then curtailment occurs where there is a significant reduction in the number of employees covered by the plan. So when some have retired, the number has gone down, some have moved to, have changed employment, then you can renegotiate or you make adjustment to the scheme on the amount which should be contributed, and that is called curtailment or reduction. Settlement occurs where an entity enters into an agreement to eliminate the obligation by paying the retirement benefits. Of course, settlement is where the benefits have been paid. So service cost component, mostly whatever curtailment and settlement, it takes into consideration the current service cost, which was incurred in the current year, and the past service cost, and all the two must be charged in the P&L for the current what? Financial period. Interest cost component, this relates to the changes in measurement of both planned obligation and planned asset arising from the passage of time, computed by applying the discount rates for the planned obligation and the expected rate of return on planned asset at the beginning of each financial year. Interest cost component is an expense to the employer, while the expected rate of return is recognized as what? Income. So interest cost component, there are two. For what has been saved, you recognize a return. For the obligation, you recognize interest expense. Then we have remeasurement component. This comprises the actuarial gains or actuarial losses arising during a financial period. Actuarial gain or loss is the increase or decrease in the net pension assets or liabilities that arises due to changes in the actuarial assumption or due to differences between the previous actuarial assumption and the actual outcome in the scheme. Actuarial gain stroke loss are to be recognized as other comprehensive income during the financial period. So remeasurement, what you do, you know, all these, they are normally based on estimation. So the actuary, they tell you that if you contribute this and this and this, by the end of year one, though this one is not related to this, CBK, uliona kuna bond walipeana juzi. I think it's expiring on 6th June. Okay. I don't want to tell you a story. Wakapeana minimum, what you will be expecting at then. It is an 18-year bond. Wanakwambia upeleke 200 million hapo CBK. Then after 18 years, you will see what will be your account. But 18 is kidogo. 18 years. Yes. 13.34%. Annum. No, but there is no finance cost. They said the finance cost is not there. You only check on the coupon, which is 13.34. So you will redeem how much? If you redeem the nominal, some make 1 million, but they allow up to 100,000. Yes, they are investing next year. So now, you get 1 million. 2.3 million. After 18 years. Now, kinunua shamba sahi na hiyo 1 million. Ukinunua shamba sahi 1 million uuze after 18 years. Tuseme hapa Kiambu, Mungu amekusaidia upata shamba ya 1 million, which I know you can't get 1 million. After 18 years. Just ile fix hiyo tulishapita hapo. Niliona nikacheka nikasema. So The scheme, they will give you the projections. So right now, this is your savings. You have a saving of 1 million plus all this. So they actually will anticipate that by the end of year one, your savings will be 600. At the end of year one, the actual, you find that the actual outcome in the scheme is 580. So the variation between the actuarial assumption is what the actuary had anticipated. Nataka mwelewe so tukienda kwa computation, you'll be understanding all of them. What they had anticipated versus the actual what outcome in the scheme. So the examiner, what the examiner will provide you with is the what was there at the start and the actual outcome. Then you try to project. So you are the actuary here. You project, then you compare with what the examiner has given you. So the difference between the two can either be actuarial gain or actuarial what? Loss. And how do you recognize? As part of other comprehensive, because it's not a normal business income. So elements of remeasurement components. So andika hapo hiyo city. That is the question we have read. May 20 in brackets, May 2021. Question 5C. May 2021, question 5C. May 2021, question 5C. 1, so the elements of remeasurement, when you are carrying out remeasurement, you must report to us the actuarial gain and actuarial what? Losses. Because remeasurement means, you know, the amount is always projected in advance. So when you assess the scheme again to check the actual outcome, you must determine actuarial gain or actuarial loss. Return on plan assets, then any changes that affect the plan asset, excluding interest components. Accounting treatment under Ifrs 39. So for government, see, how do you account for them as per Ifrs 39 and under IS number 19? So according to Ifrs, the remeasurement component, the gain or losses, should be recognized to equity and should not be classified to surplus or deficit in the current and subsequent what? Periods. So with them, they take them straight to equity because government, other comprehensive income. So for Ifrs, you take them as part of equity components. Treatment under IS 19. IS 19 requires that the measurement components, the gains or losses, should be recognized as other comprehensive income during the financial period under consideration. Defined benefit plan should always be measured at fair value, while defined benefit liability should be measured at their present value. Illustration, 2017.
Yeah.
So what I want to list all the sittings, which I want us to do first. So andika hapo December 2017, question 2C. December 2017, question 2C. May 2019, question 3A. November 2020, question 5B. April 2022, check for me which question. I just know there was a question, but I don't know which question. May 2022, can someone check for us? May 2022, which question? There was last sitting, a certain question there. Question 3B. April 2022, question 3B. Hizo bado tukifanya kama hizo leo hizo zote si hata tukifanya 100 of them. So those ones will be enough. So Lucy tumeona. So let's meet on Monday. We were supposed to start our weekend classes. I wanted to bring you on Sundays tomorrow. But let's start next week. So let's meet on Monday. Sawa sawa. Sawa. What was it? So anything we are doing from now onwards are very crucial for your exams.